Hello people, this is Dr. Wang here recording. In this video, we are moving to a very exciting chapter, stocks and their valuation. Here I bring you a picture. This is from a pro-Bitcoin website actually, but it shows you how much your investment in stocks would grow over a course of a period. And you can see that on the list here, we have Nike, Walmart, Coca-Cola, Walt Disney, so on and so forth, all these popular famous companies. The chart shows that if you had invested $100 at the initial public offering date of the stock, IPO stands for initial public offering, which is the first day the stock became available to trade for the general investor public, and how much you would have in the year of 2019. So if you invested in Walt Disney back in like 1919, which is 100 years ago, then you could have $753,000, and that's quite a lot from $100. But if you amortize the growth at a yearly level, the return is actually 9%. But still, that's considerably high. And if you look at Nike, well, if you invest $100 in Nike back in 1990s, is right here, the black curve, and then $100 would grow to $6.07 million. And now we're talking, and we're looking at a tremendously high return here. And I actually verified this number based on the real data, and it is true from my own experience. Although the stock price right now is not that high, it's because Nike stocks has done several stock splits to drive down the stock price. But if you invest $100, you can reach over $6 million in about 30 years. And you can see some other of the companies. If you invest $100 at the initial public offering date, the growth of your money would be pretty large. And this is from a pro-Bitcoin website. You can see that for Bitcoin, the investment in return is actually the highest or the fastest. The chart basically shows that in the United States, investment in stock is good. Not just for those famous stocks we mentioned earlier, in the last picture, but also for the general stock market. If you look at this chart, this is the Dow Jones Index ranging from 1896 to 2018. As you can see, the trend is pretty steady upward. Well, there definitely was some stock crash in 1929, the Great Economic Depression, and there's some stock crash in 2008 financial crisis. But if you see the market over 100 years, then the price just keep increasing on and on. Of course, when we had the COVID-19 pandemic, the stock price suddenly plummeted by a lot, and it caused a circuit break in the stock market 4 times in a week. But still, the stock market caught on in the later several months, and it's still pretty stable as it is today. So our system works. As long as the companies are making cool products, selling them, making profit, creating value to the society, hiring people, the stock price should go up. This picture shows you a old certificate for stock shares, and this is 10 shares of a company called Baltimore and Ohio Railroad Company, and it has $100 per share as the issue price or the book value per share. So when the stock first became available to the public, it was sold at $100 par value. And of course, if the company's profit is more than expectation, then the price definitely will be over $100. If the company had a performance lower than the expectation, then the stock price would be less than $100. So it really depends on the stock's performance. And in this chapter, we're going to learn how to value a stock. And we are going to use the 2 kinds of models. One is a discounted dividend model. In this model, we assume that the stock generates dividends and the present value of the dividends would be the current price of the stock. It's the same idea we use to estimate the value of any financial assets. And another model is called a corporate valuation model. This model exists because for certain companies like Facebook or Microsoft before 2003, they never paid a dividend. So for this no dividend stocks, we can still have a method to get their fair price. And this is called a corporate valuation model. In particular, we're going to estimate the free cash flow generated by the firm and discount it with the cost of capital to get the present value, which is the price. Let's first move to the discounted dividend model. As you can see, the current price equals to dividend 1, the dividend in the next year, discounted by 1 year, and RS here is the required return of the stock. Just like what we did with the bond, the required return would be higher if the stock has a higher risk level. So when the investors are facing more risky stocks, they would require more return for compensation. So this required return would get larger. And we are going to use this to discount all the cash flows. When you have a larger discount rate, then your present value would be lower. That means the stock should be cheaper. Here we have a way to calculate all the dividends if they grow at a constant rate g. The dividend does not stay the same when the company makes earnings and they save part of the earnings and then they make the same rate of return the next year just because they have more base from the saving and then pay more dividend. So that's how the game is played. So when a company saves money, they grow bigger and they can make more profit and pay more dividend. And this is how we calculate the dividends. So the first period dividend equals to the dividend today times 1 plus g, the growth rate, raised to the power of 1. The second year dividend would be dividend 0 times 1 plus g to the second, or dividend 1 times 1 plus g. In the valuation of a stock, we always assume perpetuity. So what does perpetuity mean? Maybe you have watched the Game of Thrones and there was some explanation to perpetuity.
And perpetuity means? What does perpetuity mean, Lord Tyrion?
Forever.
Forever.
Yes, perpetuity means forever. Here we assume the dividend to grow forever, infinite amount of years. That basically means the dividend would never run out. Of course, a company would not last forever, just like Aaron or WorldCom or Lehman Brothers in 2008. They all went bankrupt. So if there is a higher risk of stock, we still assume the dividends will be paid forever. We still assume this perpetuity. The thing is, we're going to use a larger discount rate for the assumed infinite amount of dividends. If the company has higher risk of default, then we would enlarge the required return, which is adjusted to the risk level. Then the stock price would become cheaper. So for risky companies like Lehman Brothers in the year of 2008, the stock price just plummeted, just get lower and lower from $60 to $40 to $12 to $2 and so on until it got bankrupt. And thanks to the mathematicians, if we have perpetuity, we don't have to generate infinite amount of dividends and discount them all and take the summation of all these present values. We just need to use a very short, crisp formula to get the current price. So the price today equals to dividend 1 over the required return for stock, S stands for stock, minus the growth rate. And the dividend 1, of course, equals to dividend 0 times 1 plus g. It is a 1-year growth from the dividend in the last year, which is today. And if you look at the trend of the dividend, since the dividend keeps growing at a positive rate g, then the amount of dividend in dollar figure would keep going up, up, and up. And if you look at the present value of each dividend in the future, you can see that you have a discount rate here, which is greater than the growth rate. So that basically makes the future dividends at present value lower, lower, and lower. So if you add all of these present values together, then you would have a finite amount for the summation. And then that finite amount of summation is your present value of the stock or the current price. If I use Excel to illustrate, let's say we have an infinite amount of years, and we have a year 0, year 1, year 2, and I'm going to generate infinite amount of years, but I cannot. I just simulate and generate a lot of years. Let's say now I have over 2,000 years, and that is a good imitation for perpetuity. And then for my dividend, let's say right now my dividend is $2, and the growth rate of the dividend G equals to 5%. So the next year the dividend would be the previous year's dividend times 1 plus 5%. So that becomes $2.1. And then I will replicate the calculation, decrease the decimal. As you can see, since dividend keeps growing, it gets larger and larger, and after hundreds of years, it will become a tremendously large number. But it does not matter because it is not the dividend per se I'm going to sum. I'm going to sum the present value of the dividend. So if you look at the dividend today, the present value is just itself. Or we can use the discount rate of 10% raised to the power of the year number. So anything raised to the power of 0 would become 1. So that is just itself for year 0. And then I just replicate the calculation for all the other years. As you can see, the first year dividend, when you discount to the present value, 2.1 divided by 1 plus 10% raised to the power of 1, that gives you 1.91. And the second year's dividends would have a 1.82 present value. As you can see, although the dividends are getting larger and larger, but the present values are becoming smaller and smaller, and after hundreds of years, it just became neglectable. It is less than 0.00. So if I add all these numbers, by the way, I should start from dividend 1. If I add all the numbers, here is my answer. It's $42. Well, the reason I started from the first period is because when I bought this stock, I do not get the $2. This $2 dividend was already paid to somebody else. When I buy the stock, I only receive the dividends from the first year to the last year if I hold the stock forever, or anybody holds the stock forever. So when you do the calculation, you should count the first year dividend, not the dividend today. But you can always use the dividend today to get the first year dividend. Okay, so it's really important. Since my total summation is $42, if I get back to the PowerPoint, this is my formula, dividend 1 divided by required return minus G. Well, if I use the first year dividend divided by the required return, which is 10% minus a 5% growth rate, let's see what it's gonna give me. It is $42, exactly the summation of all the present value of dividends. So the formula works. You don't have to generate infinite amount of dividends. You just need to use this formula. And what happens if the growth rate is greater than the required return? If that happens, it just doesn't make sense. The growth rate is too high, and the required return is too low, and the stock price would become a negative, so the model would fail to explain the stock price. And in this question, we have a dividend growth rate equals to 6%. The dividend today is $2, and you're expecting to see the next 3 years of a dividend. So you can use the dividend growth formula. 2 times 1 plus 6%, that's your first year dividends, and you discount it by 1 year with a 13% discount rate. So this is your present value for the first dividend. And for the second year, it is $2 grow by 6% for 2 years. Then you discount it with 13% rate for 2 years. This is your present value for the second dividend. And you do the same thing for the third year dividend. To get the price 0, you use a dividend 1 divided by the required return minus the growth rate. And this is price 0. That's pretty straightforward and easy. And what about if you want to know the stock price a year later, not the price today? Then you should use a dividend 0. Then you should use dividend 2, the second year dividend, as the numerator in your formula to get the price a year later. So P1 equals to dividend 2 divided by the same denominator, required return minus growth rate. So that's how the stock price would change based on this model. And here are some important concepts. The first one is a dividend yield. It is the first year dividend divided by the price today. It tells you the percentage return generated from receiving dividend only. And the second one is called a capital gains yield. We cover this in the bond chapter. It is the later price minus the earlier price, the difference divided by the earlier price. And this is the percentage return from the price change of the security. And of course, your total return would be the summation of the two yields, and that is a 13% return. Does that ring a bell? In the previous exercise, your required return is 13%, as it here, and it is here. So when the investor requires 13% return to be paid by the stock, then the investor will get 13% return. Otherwise, this stock would not exist. If they don't pay enough, then investors would run away. They can't attract investors, and the firm would not pay any rate higher than 13%. That's unnecessary. All right, so if the dividend growth is 0, P is 0, that's even easier. You have the fixed amount of a dividend in the perpetuity. This usually applies to preferred stock. And Warren Buffett is very fascinated with the preferred stock. The dividends for each year is fixed, just like the coupon payment from the bond. For stocks, there is an unlimited amount of year of duration. And here we have some supernormal growth. We call it a two-stage growth. So what if the growth rate is 30% for 3 years before achieving long-run growth of 6%? So in the first stage of the 3 years, the growth of a dividend is 30%, and then it is 6% lasting forever since the 4th year after 3 years. And here is your dividend 0, and you are going to use the 30% to get dividend 1, dividend 2, and a dividend 3. And then you can also generate dividend 4, 5, all the way to dividend infinity, and then discount them all, sum of them all. That is the old trick. The easier way is to get price 3, which summarize all the dividends starting from the 4th year. So price 3 basically is built upon dividend 4, 5, 6, 7, all the way to dividend infinity. And for an investor that purchases the stock today, and this investor will sell the stock 3 years later, and to this investor, the cash flow would be dividend 1, dividend 2, dividend 3, and then price 3. And the price 3 includes all the dividends thereafter. So we can just use the constant growth model to get a price 3, and you should know that the numerator in your formula should be dividend 4. It is always the dividend a year after the price you are solving for. If you're solving for price 3, the dividend in the formula should be in the 4th year. If you're solving for price 1, the dividend here should be in the 2nd year. And you have the same denominator, which is the required return minus the growth rate. And this growth rate, of course, is the growth rate in the 2nd stage, not the 30% growth rate in the 1st stage. So if you discount all of them, then you would add them up, and you can use the net present value function to do the job. And the best way, in my opinion, is to use Excel. So I'm going to delete all the previous example I had. So now let's say the first growth rate G1 equals to 30%, and the second stage growth rate is 6%. And the dividend 0 is still 2. The required rate of return is 13%. And right here for the first year dividend, it will be the dividend today times 1 plus 30%. Okay? All right? And then I will drag it for 3 years, and that's the dividends for the first 3 years. And each year the dividend is 30% higher than the dividend before. And then starting from the 4th year, my dividend growth becomes 6%. So I will use the dividend 3 multiplied by 1 plus 6%. All right, and then I just double click on the right corner, and you can see here are my dividends. Each is 6% higher than the previous dividend. And then my required return this time is 13% as it is given in the textbook. Apply no borders and add the border back there. So you can see for each of the dividend, I divided by 1 plus 13% required return with to the power of the year number. If it is year 0, the dividend present value is just itself. If it is year 1, then discounted by 1 year. If it is dividend 2, discounted for 2 years, so on and so forth. As you can see, the present value gradually becomes 0. And my final step here is to add them all together from the present value of the first dividend to the last. So this is my answer. So this is price 0. Okay, and this is done based on computer simulation. I have generated thousands of years, but in reality, you are going to use a mathematical formula, and that is actually easier. So how exactly do you do it? In your calculation, you are assuming that you hold the stock for 3 years. All right. So in the 3 years, you are going to receive hold for 3 years. Why is it 3 years, not 4 years, not 5 years, or 2 years? It's because the 30% return, the 30% growth rate lasts for 3 years. All right. So you assume you hold the stock for 3 years, then the dividend you're going to receive would be dividend 1, dividend 2, dividend 3, and then at the end of the 3rd year, you sell the stock and get the price, whatever the price is, at year 3, and this is a P3. So how do you get P3? It is the 4th year dividends, which is 1 year after price 3, divided by the required return of a 13%. The required return always comes first, minus the 6% second stage growth rate. All right, not 30%, because after the fourth year dividends, the growth rate will become 6%. Then you hit enter, so that's the stock price 3 years later. If you hold for 3 years, then your cash flow would be dividend 1, 2, 3 and price 3. And you are going to use the net present value function. The interest rate would be the required rate of return, and your first cash flow would be dividend 1, second year cash flow would be dividend 2, and the third year cash flow would be dividend 3 plus price 3, and then hit enter. As you can see, the current stock price 0 is a 54.11. You can either assume perpetuity, take the summation of an infinite amount of dividends at the present values, of course, or you hold the stock for 3 years and sell the price at a price 3 at the end of the third year. Why you assume that? Why do you assume 3-year holding period? It's because the first stage lasts for 3 years, and it is the easiest if we do such an assumption. If you assume you hold it for 2 years, that's going to be more complicated and messy, but you still will get the same result. It's just this way is the most efficient way to get the price today. Now let's take a look at your assignment. Right here, you are analyzing a company's stock, and this stock has a growth rate of 8%, and the current dividend is $1.25, and your required return is 15%. So if you expect the dividend will grow at 8% forever, what is the highest price you would recommend purchasing? Well, this is an easy question. You have a dividend 0, and you only have a one stage of growth that lasts for perpetuity, and the growth rate is 8%. So just use the Excel model I showed you earlier. The first year dividend is 1.25, and then it will grow by 8% forever, on and on. Okay, just change all the growth rate to 8%. And your required rate of return is 15%. So just use the 15% return here and apply for all of them. Delete the borders. All right. So your price would be 19.29. And you can also use the mathematical formula to get the final result. You can use the first year dividend, is very important. You can use the first year dividend divided by 15% return minus 8% growth rate. So that's the same answer. All right. In question B, suppose now the company will have a 20% growth rate for the first 3 years, followed by an 8% growth rate. Of course, that's going to last forever in our assumption. What is the value of the stock? And in this case, you have a 2-stage for stock growth. The first lasts for 20%, so G1 equals to 20%, G2 equals to 8%, and the required rate of return still is 15% return. Still is 15%. And when you apply the calculation, when you do the calculation in the first stage, it is going to be 1 plus 20%. All right, and then it's going to last for 3 years all the way to year 3. And since the 4th year, it will become 8% on and on. So it's always 8% growth from the last year. And your required rate of return is always 15%. The Excel will automatically generate this result. And if you check for part 3, I can do a little bit of adjustment. Since the required rate of return in this case is 15%, the second growth rate is 8%, and that is my price 3. And to get the net present value, the required return is 15%, and your cash flows are still dividend 1, dividend 2, and the last year is dividend 3 plus part 3. Hit enter, so this would be your answer.